Hey everybody, welcome to today's webinar. Give us about 5 seconds, let people come on in, and we will get started. Our very special guest, Logan, will talk about what's happening in the market. Have the interest rates already shifted the market? So it'll be a great conversation. So hang tight just 1 minute. We should sing. No, I'm
Oh no,
kidding.
not Christmas music yet.
Yeah. All right, awesome. The numbers are growing. Wow, there are a lot of people in here today. Thank you all for taking time out of your schedule to be with us. Welcome to today's Altos presentation. My name is Mark Adams. I'm the general manager of Altos, and I'm joined by the man, Logan Motashami. For those of you that don't know Logan, he is the lead analyst at Housing Wire. He is a recurring guest and mainstay on the Housing Wire daily podcast that just this morning crossed 1 million views. Huge. And also a regular on cable TV. So you might see his face early in the mornings talking about the housing market. But we're lucky that we have him here to talk to us today at a more reasonable time, especially for those on the West Coast, to give a presentation on what exactly is happening in the market right now. So we all know that there have been some announcements with the Fed lowering interest rates. And I think that, everyone needs to know what's happening with the market.
So it's very fortuitous timing. Nick Tamaris from the Wall Street Journal shared a update from ICE and said that home prices were actually firming up. But for us, for all of you that follow Altos, for all of you that follow Housing Wire Tracker, the market actually started to shift mid-June. And like we've always said, that it takes 3 to 6 months for other data to catch up to it. And now this is the third time, 2022, when rates started to fall, the market started to shift. And then we said it would take a few months for people to figure it out. Same thing last year in 2024, when mortgage rates started to head towards 6%. But here, the market actually started to stabilize when rates weren't below 6.64%. And that's why when we talked about it in June, said that's very interesting. Then mortgage rates fell below 6.64%. And why we always highlight that is in the last few years, whenever rates go from 6.64 to 6, the housing dynamic structurally changes. And here we are now, the third year we've tested this, and the last 9 weeks have been the best purchase application data of the year. It's pretty good.
Yeah, absolutely. And so before we jump in and start showing slides, you all want to follow along with what's happening in your market because Altos is not that lagging data that you all maybe hear about on TV unless you're listening to Logan as a featured guest. So I want you all to do me a favor. If you don't have an account, go to the link that is dropped right now in the chat. It takes maybe 15 seconds to sign up. We will give you a free zip code report, a free city report. All it takes is your name, your email, create a password, get onto the platform. You're good to go. The chat function is open. We're going to have a Q&A session with Logan here at the end. So please do share any questions that you have. We will try and get to them. The number one question that we get is what's happening in my market? We cannot answer that question for every one of you, but the Altos platform can. So go ahead, enter your information, get your free report, take a look. We're going to show you exactly how to navigate it at the conclusion of Logan's presentation. But we're really thankful to have you guys here. Click the link, get your free report, and follow along. So Logan, please take it away.
Well, right now, what I saw is inventory was actually growing on a very healthy year-over-year basis. I was very happy for it because for housing to heal itself back on, you need more supply. But inventory was growing at 33%, and then all of a sudden things started to slow down, right? And you could see it in our Altos data that the growth rate started to slow in June. And then, after we make some holiday weekend adjustments, it really kept that slow pace until the month of August, which is very rare for our data lines in the last few months or the last few years. Inventory would still be increasing in August. It declined. So we try to connect the dots here, slowing down in June, July, inventory fell, and then all of a sudden the entire housing dynamics of the previous 6 months before that changed. So it shouldn't be shocking to a lot of people that pricing firmed up a little bit, and that was what the Wall Street Journal talked about this morning. And it's just incrementals because you're still working off the data that's old. And for those that follow the tracker, you realize the market already shifted, but you can get it for your own neighborhood. Every city, every state, every zip code is going to be different. Florida is different than Boise. Boise is different than North Dakota. North Dakota is different than Orange County, California. But In this way, you can be ahead of the curve. You can show your sellers and the buyers that you have the right proper information, so you don't have to wait 3 to 6 months for this to occur. And inventory growth has slowed down. If it doesn't grow anymore this year, then we actually peaked in August, which is very rare for us.
That's great. So, all right. So inventory has plateaued. The data showed this early. So 3 months, 4 months ahead of what's going on.
By the time you see this in the existing home sales report, you're already 3 months behind. And this is now the third year this has happened, right? And how you're supposed to get live, fresh data, especially for your areas, you can get it through Altos. You can get the whole enchilada on how to do pricing. There's a reason why Wall Street and real estate investors and prolific realtors come to us. They want to be better, above the trend. They want to be the top in their business. And with this kind of data, you can say, oh, guess what? The market is shifting in this sense for buyers and sellers as well in this regard. That's why it's always key to have live, fresh data. And the last 3 years have shown this in the most prolific way out there for everyone to visually see.
Yeah, and one interesting thing is, we've been doing these webinars, Altos as a whole, for decades. And everyone always asks, I want the slides, I want the charts. So you'll notice that we're doing something a little bit different today. We're actually doing this whole thing from within the Altos platform. So where we're at right now is inside our advanced analytics platform, which is available for our premium or advanced tier customers. We have added on the pendings data, which is available. And I think that's what we want to talk about next.
Yes.
How has pendings changed?
So the pending weekly sales data these are homes that go into contract, right? And when they go into contract, they typically fall into the sales data 30 to 60 days later. Now, for everyone that remembered, Redfin said it was the greatest sellers buyers gap in history, which I questioned because I remember 2007 and 8. But the pending data that we had during that entire time when people were freaked out was still showing growth. So to us, that wasn't the case. In 2022, in the second half of 2022, it was really apparent, right? We always call slope of the curve economics, but the pending data, now that mortgage rates started to get below 6.64, starting to pick up a little bit. This isn't the V-shaped recovery in COVID, but it's enough to change the market narrative that was not the case in the first 6 months, but now you can see it, right? And for every city, for every zip code, it's going to be different. And this is why when you have this information, you can show your clients, hey, listen, this is what's happening right now. You don't want to wait 3 months to get the reports. So you can act on it, because for all of you, it's much better time-wise to be more efficient and don't sit with a seller that's still thinking it's housing to 2021. You want to give them the right information, and the pending contract data actually showed a little bit pickup, and it's picked up a little bit more the last few weeks.
So I know we didn't plan on doing this, but let's talk about markets that are hot right now. Is that something that we could do?
Well, I would say generally, because the rates were elevated early in the year, all the markets are kind of picking up just a little bit, right? And there's other markets that are stronger. Of course, we always think about the Northeast. That's more of a supply story, right? Supply is so low that there's just too many people chasing too few homes. But generally, when the national forward-looking data starts to get better, purchase application data, weekly pending contracts, total pending contracts, they're all moving, because housing economics is really general economics, right? What drives mortgage rates lower picks up demand. And after 2010, every single rise in home sales really revolves around the 10-year yield. This is why I watch the 10-year yield. But the pending contracts in your area could also pick this up.
So let's talk about interest rates. I mean, you said it earlier that we've had sustained 6%.
Well, we've gone from 6.64 down towards 6. Now, when we start to get to 6, it gets very difficult to go below there. Now, this is now the third year. Whenever we get down towards 6%, the market stops. And that really makes sense with Fed policy. But during that time frame, we did see the demand curve change, right? So mortgage rates might not be able to get below 5.75 until there's a recession or the Fed goes dovish. But during this time frame in the last 3 years, whenever rates get to that level and your weekly data starts to improve, you go with that, right? Because it's going to take months before you actually see it in traditional media outlets. And that's why we follow the 10-year yield and mortgage rates and how it works with our weekly pending sales data, our total pending sales and purchase application. That's the tracker for you that we provide every weekend.
Well, let's jump into the next category, and then I want, your crystal ball analysis of what's going to happen with interest rates here as we conclude the year. But we are also tracking percentage of price decreased across the country. This is a national view right now, the past 3 years.
Yeah, one of the healthier things for this marketplace is that the growth rate of price cuts increased to a level to where the buyers could actually come into the marketplace and they have a seat at the table. The housing market was savagely unhealthy in the late 2020, early 2021, and early 2022, but now it's a more balanced market. Some areas price decreases are much higher than others. Some areas the price percentage cuts are lower than the others. But in this sense, even the price cut percentage data started to slow down and has fallen, has not been able to recapture its higher rate, and now the seasonality comes in. So we have three sets of data lines that have shown that the national markets have changed with inventory, with price cut percentages and weekly pending sales, but that's the national data. You need to find out what it is in your city, state, zip code, wherever you farm. And this way you can provide that live experience data for your sellers and your buyers, because both are now part of the game. It's not like it was in early 2021. Anyone could list a home. It doesn't matter. You have 50 people buying. Now everyone has a shot in the game. And the more data they have, the more prolific you be, and the more you become a trusted source.
All right, so Fed announced multiple rate cuts could be expected before the end of the year. Are they going to do that?
I'm not quite sure, but again, the Federal Reserve is, by its nature, going to stay as restrictive as possible. The only reason mortgage rates are even down here is because the labor market got weak. So last year, of course, mortgage rates got to 6%. The Fed cut rates just shot up. It's a little bit different now this year. We have 1.25 of rate cuts in the system. The labor data has gone from averaging 160,000 jobs per month in 2024 down to sub 25,000 really. If the labor market didn't get weaker, rates wouldn't be here. So we are probably at the lowest levels when you start to get to the 5.756% rates on the 30-year fix. Of course, ARM loans are going to be a little bit more popular now because they are going to be different than the 30-year, not unlike last year. But here we're kind of at the low point of level. Unless the Fed gets dovish or the economy gets weaker, there's not much room to go to the downside. And again, the third time this has happened, it's not by accident that rates get down to 6%. And the Fed starts talking hawkish and they go, hey, wait a second, don't get ahead of ourselves.
So there's obviously a government shutdown going on right now. There's a lot of grumblings out of Washington that that's going to result in government workers losing their jobs. Do you foresee that impacting the jobs number in a significant enough way for the Fed to shift any kind of policy or take that into consideration?
Absolutely not. They're too small. And there's over 162 million people working. So hypothetically, even if you lost 100,000 or 150,000 jobs and it fell into the jobless claims data or the BLS Jobs Friday, that's just not big enough for them. And the market realized this as well. These government shutdowns could turn like this. So in its sense, it's not going to be a big rate driver, because even if you laid off people, they put them back into work after the government shutdown's over with. So it's a wash. What we've seen is manufacturing jobs being lost, residential construction jobs being lost, but consumption data is still holding up. GDP is still over 3%, right? Stocks are at an all-time high. So as long as the US consumer is consuming goods and services, right, we're quite not there yet to get in a recession. If we saw jobless claims accelerating higher, well over 300,000, then it's a whole different ballgame. Then you could have lower rates for longer. But for right now, it's the same tug of war that we've seen back and forth. It's just that the labor data was much softer than the Fed realized. Even though they were talking about that the labor market was solid early in the year, it clearly wasn't the case. So it will be more interesting once we get these job reports out later.
All right. Well, Logan is prolific online, pushing back on people that think that the market is crashing, that there's going to be a flood of market or a flood of homes entering the market. I'm going to take you inside a conversation that I had with my parents last weekend, who the AI reshaping the workforce, going to put everyone out of a job. Well, is that something that you've thought about at all, or is that again a really small group and a really odd way to come at this equation?
This is how much of a nerd I have. I have newspaper clips going back over 120 years that every form of technology was supposed to eliminate all the jobs, and every single time it doesn't happen. We still have over 7 million job openings. No, technology can create some more jobs. There's going to be some job displacement, of course, but the history of this has shown us that there hasn't been a technology yet that has made unemployment go up to 12, 13, 14, 15%. Even today, right? I would tell you this: death is an economic variable, right? Why do we have so many job openings? Because baby boomers are leaving the workforce, the silent generation. When they die and leave the workforce, they need to be replaced. Population growth is not as strong as it was early in the last century. So naturally, we just have to fill in those jobs. The majority of jobs still need some type of manual labor. This is why today, even though the unemployment rate has ticked up, even with AI, job openings are still over 7 million. So the labor market is still holding up. I would not put all the eggs in the basket that AI is going to do this. When Skynet destroyed the world, it was because of missiles. It's not because the unemployment rate skyrocketed.
But what happens to the housing market when Skynet launches?
Well, if Skynet launches and we actually live the next day, it's great, but that's a one-time thing.
Yeah, no, that's great. All right, so what other data points should people be paying attention to, whether it's within the Altos database or from the broader, economy and markets?
I would always say the simple thing for housing is that the 10-year yield, when it moves lower or higher, see how purchase application data reacts to it. Because whenever purchase application data gets 12 to 14 weeks of weekly growth, demand picks up a couple of 100,000. We saw that late 2022. We saw that in 2024. So far, in the last 9 weeks, we've had 7 positive weeks. If we could string out another 5 to 7 over the next 10 to 12 weeks, then you have enough forward-looking demand to keep increasing sales. And we could see that in our pending sales, which is almost a cheat code because we're going to be at like 3-4 months ahead of the NAR's report. So housing demand is holding at bay. If rates stay lower for a longer period, you can get that 10-year yield purchase application data to grow a little bit longer. It's just in the past few years, rates just shot up right now. But the story of housing in 2025, mortgage spreads. If any of you see a mortgage spread out there, take a selfie with it, give it a hug. If mortgage spreads didn't improve like they historically do at this stage of the cycle, mortgage rates would not have been as low as it would have been. Just to give you all an example, how bad the spreads were in 2023, mortgage rates would be 1% higher today if we had those levels. They've improved a lot. We got only 35 basis points away from normal. That's a positive for the housing story going out, because whenever bond yields do rise, the spreads keep a limit to that damage. That is probably the unsung hero of 2025 for housing.
Love that. All right, let's talk days on market for a second. Is that a stat that you pay attention to? Is it going up? Is it going down? Is it directly related to the interest rate environment?
One of the reasons why I was team higher rates early 2021 wasn't because I thought forbearance was going to crash the market in 2020. It's just that the days on market was simply too low. It's never a good thing on the national or local basis when days on market are a teenager or less, right? So the NAR has this data line that they show with the existing home sales report. Just normal would be like 30 to 45 days, all 12 months. We're quite not back to normal, but there's pockets, there's areas of the US where the median days market are longer than others. So when you have that access to that information, you can show how Florida is different than California, California is different than Wisconsin. This way you could show it takes a little bit longer to sell homes. And if rates fall down, the days on market start to cool down, it takes a little bit less. So again, there's a whole enchilada of data out there for everyone to use, but you have access to it, where 20 or 30 years ago, nobody had anything, right? You didn't even have the internet really back then. So this way you could take all the things that we do when we track housing on a weekly basis, so you could be ahead of the curve out there instead of being behind.
Love that. So as Logan's been talking, I've been clicking through the system a little bit just to display some functionality really fast. We were, again, in the advanced analytics tab of our reports. It's a great tool that allows you to build these reports. What I'd recommend you do, if you have access and you're in a premium or an advanced tier of Altos, there's going to be a link dropped in the chat. Schedule some time with Jeff Graves. He is our #1 guy in terms of getting you up to date on how to build things, how to read the data. Jeff was a realtor in his past life, and we stole him away from the industry, so you can't have him back, unfortunately. But he is really good at walking you through how to build these charts. While this does display national data, you can do the exact same thing for your market. That can be at a state level, at a MSA level, at a city level, or at a zip level, which is the most zeroed in as we possibly get. I do want to showcase one additional thing here, and then we're going to get to some questions, which is when you're in the platform, some new functionality that's been added for those that were not on the last webinar that we did. We did add in within our dashboard view here, the weekly change. So now at a glance, you can view exactly what's changed in the last week when the data refreshed, which is a great functionality. I also was showcasing the zoom functionality within our report. So when you're in your area, if you signed up for the free account, welcome. You can go ahead, click on your zip code level, and then you can start zooming in and taking a look at exactly what's happened. You can see here in the DFW market, which is where we're coming at you live from right now, we did see median list price plateau right around the time frame that Logan's been talking about. So would love to figure out a way to get you into the platform if you are not already in here. Again, it's free. If you are on a paid plan, we'd love to talk to you about using that functionality to make sure that you're getting the most out of it. And obviously, if you're interested in that advanced analytics dashboard or you need training on the advanced analytics dashboard, our team is here. The link is right there in the chat. Go ahead and click it, schedule some time. It takes like 2 seconds to do, but I promise you, you'll be able to talk about this data better. You'll be able to have visuals. You won't be like Logan, but you can talk like Logan, which is like what we're trying to do here ultimately.
Always be the detective, not the troll. And I always say this, a lot of people say, well, how do you know when housing is really breaking? Again, the new listings data is so key into us because when we see a rush of sellers, the new listings data would take off. Think about all the grifting YouTuber, terrible people on the web, on the internet for many years said that people are going to rush to sell their homes. The new listings data in 2023, 2024, and 2025, and the second half of 2020 were the lowest levels ever recorded in history, right? There's a whole story there, but when we see new listings data go vertical, the great Mike Simonson did this in 2007 when he told Lehman Brothers, we have a way of tracking housing that's a little bit more prolific than you guys. And he said, hey, listen, we see the housing market breaking. Lehman Brothers says, I don't know who you are. I have 85 analysts, go away. Mike Simonson, the legend, goes to Goldman Sachs, 20 feet across the room, says, hey, listen, we have a way of tracking data. Goldman Sachs said, whoa, they short the housing market. They made $10 billion. Lehman Brothers goes out of business, right? We believe we're the most prolific housing data trackers on planet Earth, and we could show this to you so everyone has access to this tool. And then when everybody is on the same page, it's much better out there.
So Logan, question from the audience. If you guys do have a question, please drop it in. We'll try and get to it. If the shutdown makes T-bills more attractive, what impact does that have on the interest rates?
Bond market tends to act better when the labor data gets worse. So this is a great question because this year, inflation was higher, everyone was leaving the US, the dollar was getting weaker, and we had $10 trillion of loans to fund. There was no way bond yields could go down. Labor data gets softer, 10-year yield went down. Everyone was wrong, right? And this is now the third year this has happened. Bond traders are not bond vigilantes. Bond vigilantes would be out of the work if they actually traded that way. So the market gets, bonds get a little bit better bid when the economic data gets weaker. And then when it gets stronger, bond yields go up. Think of that stock and flow with the 10-year yield and bond markets in that regards, because the 10-year yield and the housing market go hand in hand in step. So labor over everything. Forget the government shutdown, forget all that. If the economy outperforms, you still can go up in yields. The economy gets worse, right? Maybe you test the Hodor line at 380, but 65 to 75% of where the 10-year yield and 30-year mortgage rate is still Fed policy, and it's held its course in the last few years.
So what labor numbers are you looking for to see like us to go under 6%? Is that something that's on the horizon?
Jobless claims need to hit 323,000 on the 4-week moving average. And why have I said that since end of 2022? If you look at the history of economic cycles post-World War II, there's a certain civilian labor force percentage increase with jobless claims that have to happen for the labor market to break. So back then I said jobless claims heading up to 323,000, 4-week moving average. Then you got something legit. The Fed knows this as well. So we've not done that. So we flow back and forth with the rates, right? 6.7, 6.7, 6.7. But if that data line starts to break, there's nothing the Fed could say anymore because every bond trader is not going to think, let's be a bond vigilante and show the Americans how to, treat them as bad debt holders. No, bond yields will go down, mortgage rates will go down out there. So jobless claims runs everything out there, even with the BLS jobs number as low as it was, 21st century lows in job growth correction, and we're still above 6% because Fed policy is still modestly restrictive. 10-year yield will go lower if jobless claims are breaking. Has not happened yet.
So it has to be bad.
Yes, it has to be bad.
It has to be really bad.
We don't want that to happen. We don't want jobless claims to break. And And thankfully, it hasn't broken yet. So
Yeah.
hopefully that stays its course.
Don't wish for low mortgage rates under any
No,
circumstances.
no, we do not wish for a job loss recession to get mortgage rates lower.
Yeah.
We want to find an equilibrium between housing, because housing's like millions of people buy homes every single year, going back decades and decades, right? Housing got very unaffordable as prices escalated out of control, taxes, insurance, rates, but rates just getting down to 6%. We could get a little bit more traction.
Well, let's talk about days on market. We got another question. Is a normal market with 3 to 6 months of inventory, is that the right number?
So this has been an argument for a lot of people. I have not believed in the 6 month supply theory. I've always thought a normal market nationally is 4 months supply, right? So what we've seen, at least on the NAR data, months of supply is not increasing anymore in a big fashion, but it's about 4.6. It's been hovering around here. That to me is more of a balanced marketplace. 6 months supply to me get a little bit more pricing weakness. We have not had 6 months supply. We almost got it in 2020 or 2014 in a few months, but I think we got up to 5.8. So it's very rare. Why? Because new listings data, active inventory, those things, price cut percentages, most home sellers are buyers. If you think of it in that, right, then all the inventory data for 5 decades starts to make sense, because that seller is going to buy another house, inventory stays checked. But to me, the marketplace is a little bit above balance right now with over 4 months. Again, every city and state is different, but if you're talking about the nationals, the 4 months, 4.6 months supply is balanced enough, and this is why price growth is cooling down, especially in the last 2 years.
Well, we are almost out of time. I'd love to, for the everyone that's still on the webinar, drop in the chat what your current month's supply is right now. I'm really curious. I know that it is a very diverse country. Every market's different. You have some markets that are 2.7 was the first answer that came across. I'm sure that there's someone that's way higher than that and way lower than that.
And always remember, months of supply is different for every single person that tracks it. So you could say months of supply for the new home sales. By the way, we never mix the new home sales market and the existing home sales market together. Those are two different creatures. But always remember, if you are looking at your local month of supply data, back tested, have it go back 20 or 30 years, then you get to see what did it look like during the run up in 2005 to 2008. Because monthly supply was over 10 months back then. That was a market that was stressed. So each marketplace is different, but each way you track it could also be different. I see some people get confused by that out there. But to me, 2025 is the healthiest housing market post-COVID, right? Buyers and sellers are in there. Of course, I know people want lower mortgage rates, but we got away from the savagely unhealthy housing market. This is why I love 2025 more than any other year.
I think that's a good place to leave it. It is not a bad market that we're in right now. It's a balanced market. That narrative presented to your clients is probably going to help you overcome a lot of objections about, things that people are reading online. I mean, things that are happening around my dinner table with my family. The world is coming to an end. So I think that's a really good talking point.
Yes, and always remember, buyers and sellers work together, because most sellers are buyers, right? A functioning housing market has active inventory up and supply up. This way, it doesn't become a savagely unhealthy seller's market. 2025 is a blessing for the housing market. It allows you to heal for many, many years to come.
Awesome. Well, Logan, appreciate your time. Thank you all for joining us. If you have any questions, feel free to drop it in the chat. If we're obviously going to wrap here, so we'll send you a message, get back to you if you have questions about the platform, questions about the market. I'll forward those on to Logan with his cell phone so you can call him. I'm just kidding. But thank you so much for joining us. If you don't have a free Altos account, click the link in the chat. If you have one and you want to be better at the platform or do more with the platform, click the other link in the chat. We're here to help you. Thank you all so much for joining us today. Bye.